Will the RBA extend QE until 2022? Let's have a look. Hello everyone, Florian Heise here and welcome to another episode of HeiseSays. Grab your stein of coffee because we're going to have a look at a report from Westpac which is suggesting that the Reserve Bank of Australia may extend quantitative easing until 2022. Fantastic. I'm sure everyone's happy about that continued intervention into the market. Now, I'm sure some people actually are. Now let's have a look at first, what is quantitative easing? Because, well, a lot of people didn't really hear about it until recently. It seems to be the popular thing, isn't it? So, quantitative easing, and this is from Investopedia, is a form of unconventional, would you call it unconventional these days? Monetary policy in which a central bank purchases long-term securities from the open market in order to increase the money supply and encourage lending and investment. Buying these securities adds new money to the economy and also serves to lower interest rates by bidding up fixed income securities. It also expands the central bank's balance sheet. When short-term interest rates are either at or approaching zero, I'll just bring up this cash rate chart here to we're pretty much zero now. The normal open market operations of a central bank which target interest rates are no longer effective. Instead, a central bank can target a specified amount of assets to purchase. Quantitative easing increases the money supply by purchasing assets with newly created bank reserves in order to provide banks with more liquidity. Now, increasing the money supply is the traditional definition of inflation. That by itself is the old school definition of inflation. Now we have arguments that it's to do with prices, the price of goods and services. But here's a quote that I want to draw your attention to. The Cantillon effect. Now it refers to a change in relative prices resulting from a change in money supply. The change in relative prices occurs because the change in money supply has a specific injection point and therefore a specific flow path through the economy. So with QE, reserve banks around the world are injecting money into the economy, and that money is going to have a specific flow path. So that's why we would see the Cantillon effect bubble up in certain areas. What do you think would manifest in Australia? I'm just wondering, increasing bank liquidity and then the ability of the banks to lend out money. Where would that increase it? I wonder. I wonder. We all know it's all housing here in Australia. Quantitative easing, and here are the key takeaways, is a form of monetary policy used by central banks as a method of quickly increasing the domestic money supply and spurring economic activity. Quantitative easing usually involves a country's central bank purchasing long-term government bonds, as well as other types of assets such as mortgage-backed securities. In response to the economic downturns caused by COVID-19 pandemic on the 15th of March 2020, the US Federal Reserve announced a quantitative easing plan of over $700 billion. Then on the 10th of June 2020, after a brief tapering effort, the Fed extended its program, committing to buying at least $80 billion a month in treasuries and $40 billion in mortgage-backed securities until further notice. So the US are just, well, the Fed's doing it. And, the RBA and QE, we were a little bit slower, but we've been talking about this for a year. Quantitative easing is coming. Australian quantitative easing. Media is encouraging quantitative easing. Quantitative easing in 2020. Infinite QE. So the RBA is essentially committed to it. And you can find all these videos on this channel that we've discussed that time and time again. So let's have a look at this bulletin from Westpac discussing quantitative easing and if it's likely to be pushed into July 2022, and what impacts do you think that will have on the market, everyone? So, RBA is set to extend QE, but last purchases are likely by July 2022. We are forecasting that the RBA will extend its quantitative easing program with a third $100 billion QE3, which will begin in the first weeks of September. And I'll zoom in here so we can see this. The move will complement the decision to extend the yield curve control policy to purchase the November 2024 bond at the cash rate of 0.1%. We expect both policy extensions to be announced with the board meeting on the 3rd of August. We see the bank adopting a clear policy approach of not tightening policy in 2021 with a view to reviewing the policy stance in 2022. And we're hearing similar things coming out of the Federal Reserve. If there's any inflation this year, they think it's just going to be transitionary and not really intervene. They're hoping, that the market will adjust and inflation rates will hit down by next year. We'll have to see. This interpretation is still consistent with the likely decision not to extend the term funding facility beyond June. That policy was adopted to assist banks to maintain high levels of liquidity during the uncertain times of the pandemic. With ample liquidity in the system, it will be appropriate for the RBA not to extend the TFF. QE and yield curve controlled are aimed at boosting demand and employment through containing upward pressure on the Australian dollar and supporting confidence that the RBA still expects that it will not be rising the cash rate before 2024 at the earliest. Accordingly, at the February board meeting in 2022, we expect the board to announce it will not extend the yield curve control policy to cover bonds maturing in 2025, April 2025 bond and beyond, and it will be tapering its QE program to $50 billion in purchases from early March when QE3 has expired. We expect that the $50 billion extension QE4 will be the final tranche of the program, or in the program. In that regard, it is interesting that the minutes of the April board meeting noted that by the end of the current program, QE2, the bank will hold around 30% of Australian government securities on issue and 15% of semi-government securities. This observation indicates that the bank is very mindful of its potential to restrain liquidity in the bond market. In this note, we project the RBA's holding of Australian government securities by June 2022 near the completion of QE4. We consider RBA's holding of Australian government securities overall, make an estimate of the RBA's expected share of holdings of long-term securities, and compare RBA's positions with the Federal Reserve, the Reserve Bank of New Zealand, and the Bank of Japan. So the RBA's holding as a share of Australian government securities on issue by June 2022. Our forecasts are based on the following assumptions with respect to future bond issuance over the remainder of 2021 and 21-22. So the FY 2021 deficit will be $150 billion, roughly $50 billion less than the current mid-year economic and fiscal outlook forecast of $197.7 billion. The financial year 21-22 deficit will be $85 billion, which incorporates a $50 billion reduction from the mid-year economic and fiscal outlook forecast of $108.5 billion, offset by $25 billion in new spending and tax cuts. So if we zoom up here, this is figure 1. The RBA's holding of Australian government securities, 38%. The RBA's holdings of 4 to 12-year bonds, up to 52%. And here's the RBA's holdings versus the Fed holdings of government securities. And there's the Fed, and there's, okay, well, Aussie. I don't want us to beat, you don't want to beat the Fed. Here's, let's have a look here. Let's look at some of the other ones. This is the RBA versus the RBNZ and the Bank of Japan. Where's Bank of Japan? There you go, Bank of Japan, 45. Whoa, what the, what's, look at that. What is New Zealand doing? Wow, they've hit Japan. That's, there you go. There you go, everyone. So, you know, we're worse than the Fed, but we're not as bad as Japan or New Zealand. So, what do we have here? 3. The AOFM issuance program will be adjusted for revised budget estimates. Figure 1 sets out our estimates of RBA's share of total AGS on issue. We therefore estimate that at the end of the QE program, the RBA will hold around 40% of total Australian government securities on issue. RBA's holding of 4 to 12-year maturities on issue by June 2022. Now, here's the thing. I mean, who's going to buy these things back? Are they going to sell them? The problem is whenever they try and scale back QE, the market doesn't respond very well. You know, is it a trap? Can you fall into this trap of just perpetually needing QE? I mean, how long has Japan been doing this type of stuff? What's their economy? They're kind of like some zombie economy now. They've got a whole lot of issues going on there. So we now consider the RBA's ownership of Australian Government Securities in the 4 to 12 year maturity range, which corresponds to the securities that the RBA has purchased under QE to date. Our forecasts are based on the following assumptions. 75% of new issuance of AOFM will be in the 4 to 12 year maturity range. Future QE purchases will continue to be in the 4 to 12 year maturity range. Figure 2 sets out our estimates of the RBA's forecast share of holdings of AGS in 12 and 4 to 12, and they estimate it here. Let's have a look here. Let's just jump ahead to... So, the RBA will be cognizant of QE distortions seen in other sovereign bond markets. The RBA's ownership of the bond supply will run well ahead of the Fed by June 2022. By this point, RBA ownership will more closely resemble the Reserve Bank of New Zealand, which currently owns 44% of central bank securities, and the Bank of Japan, currently owning 45% of JGBs and T-bills. See figure 4. In Japan, there are signs that the Bank of Japan's asset purchase program has distorted the government bond market. As shown in figure 5, a dealer-to-client transaction volume has fallen roughly 30% compared to the average over 2012, the year before the Bank of Japan launched its quantitative and qualitative monetary easing program, and the volatility of the 10-year bond has steadily reduced over the same period, moreover widening bid-ask spread points to some crowding out of private investors. In New Zealand, the Assistant Governor of the Reserve Bank of New Zealand has previously stated that the percentage of the bond market that could be purchased without creating distortions would be in the order of 40 to 50% of individual issues. Compared to the international counterparts, the Australian Government Securities market may also be more vulnerable to distortions from central bank purchases. Firstly, around 52% of ACGB market is owned by non-residents. Many of those investors, central banks and pension funds, buy and hold sovereign debt and are less likely to contribute to liquidity by selling back into the secondary market. This compares to 13% foreign ownership in Japan and 30% in New Zealand. Of the remaining 48%, ACGBs owned by residents, roughly half are held by authorized deposit-taking institutions. ADIs are required to hold sovereign bonds to meet regulatory requirements, so net sales from this pool of investors will be restricted. In conclusion, we think the RBA will assess that it will have reached a comfortable limit in terms of its share of holdings of Australian government securities by July 2022, when QE4 expires. The RBA has emphasised in the past that it is committed to the orderly functioning of the Australian bond market. While the federal government is likely to delay budget repair for a number of years, annual deficits will still be falling. Maintaining a QE program beyond the forecast QE4 is likely to see the RBA crowding out the bond market, risking disruption to its functioning and constraining liquidity, which could perversely precipitate a widening of bond spreads as investors claim a liquidity premium to hold Australian bonds. So there you have it, everyone. Looking at, well, potential QE until 2022. So what are the solutions and the takeaways for this? Well, the question is, how can you position yourself and your assets to make sure that you can be safe and protected for any disruptions to the market? Are you worried that, the RBA will have to continue this intervention beyond the date when they hope to stop? And what about these concerns? We're approaching Japanese level of the Reserve Bank's holdings of government securities. Shouldn't we be concerned with that? I think the real test will be what happens next in 2022 when they try and stop this. What do you think? As always, thank you for watching. Please like, share, and subscribe to the channel. If you're a fan and enjoy the content I create here, there are a few ways you can support us. You can join us on YouTube or Patreon. You can support us using our affiliate links on Amazon, eBay, Independent Reserve, or AussieBroadband. You can buy merch from HeiseSays, use Gold Pass from the Perth Mint, or support us via PayPal. Take care, and I'll see you next time. Bye for now.